Well, I've been at this game for a good long while now, pushing 94 years old. And if there's one thing I've learned over all these decades is that wisdom often comes wrapped in a package labeled mistake. And believe me, I've unwrapped my fair share of those. One of the biggest, a real doozy, involves a company you might have heard of, Berkshire Hathaway itself. Funny how that works, isn't it? The very vehicle for our success was born out of a bonehead move, a classic value trap that almost took me down with it. This goes back to the early 1960s, specifically 1962. I was running my partnership then, moving money around, looking for bargains. Berkshire Hathaway was a New England textile manufacturer, a dying business, though I was too dumb to fully grasp that at the time. Its stock had been trading around $7 or $8 a share. I started buying in at about $7.50, thinking it was cheap. Textile mills were contracting, laying off workers. The industry was in a structural decline. But the stock price, oh, that stock price, looked like a bargain on paper. The management, led by a fellow named Seabury Stanton, had been closing some mills and using the proceeds to repurchase shares. This was attractive to me, created a situation where the stock price was bobbing around, and I saw an opportunity to make a quick buck by selling my shares back to the company at a slightly higher price. I remember Seabury offering to buy back shares at $11.50 for me at one point. I was happy with that, figured I'd make a little profit, but then Seabury tried to nickel and dime me. He sent a tender offer for shares at $11.37.5, a paltry 1/8 of a dollar less than what he'd verbally offered. Now, look, that may not sound like much, 1/8 of a dollar, but it was the principle of the thing. It just rubbed me the wrong way. My competitive juices got flowing. And instead of selling, I got mad. I decided right then and there, I wasn't selling. I was going to buy control of the company. It was pure emotion, a childish reaction to being undercut. And it was one of the costliest temper tantrums of my career. I ended up buying more shares, paid around 14.86 a share on average to get control. This put us in charge of a declining business, all because of an emotional decision over a tiny fraction of a dollar. It was a $200 billion mistake, measured by the opportunity cost over the decades, if you consider what that capital could have been doing elsewhere. Here's what I learned from that mistake, and it took a long time to sink in, even after taking control. Ben Graham, my old professor at Columbia, he taught me all about margin of safety and buying businesses for less than their intrinsic value. He preached buying a dollar for 50 cents. And on paper, Berkshire Hathaway at 7.50 or even 11.5 seemed like a dollar for 50 cents. But what Ben also taught was to understand the business, not just the numbers. I was so focused on the quantitative analysis, the assets, the working capital, the share buybacks, that I missed the fundamental truth. It was a terrible business. The textile industry in New England was a bottomless pit for capital. Every dollar we poured in to modernize or compete against cheaper labor overseas was a dollar down the drain. It was like fighting a losing battle, throwing good money after bad. We'd invest, we'd make a tiny return, and then inflation would eat it away, or a foreign competitor would undercut us. We were in a business where no matter how hard we worked, no matter how smart we were, the economics of the industry simply wouldn't allow us to prosper. Charlie always says you can't make a good deal with a bad person. And I'd add, you can't make a good deal in a bad business, no matter how wonderful the price looks initially. My partner, Charlie Munger, he drilled this into my head over time. He showed me the difference between buying a cigar butt, where you get one last puff for free, and buying a wonderful business that can compound capital for decades. Berkshire Hathaway was a cigar butt. I loved buying cigar butts in my early days. They looked cheap. They had a little bit of value left. But those last puffs are fleeting. You're constantly searching for the next one, and it's an exhausting, low return way to invest. Charlie got me to realize that it's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. The textile business was not a wonderful company no matter how wonderful the initial price I paid for its stock seemed. What I failed to properly assess was the moat. A moat, in business terms, is what protects a company's profits from competitors. Think of a castle with a wide, deep moat around it, making it hard for invaders to get in. Coca-Cola has a moat, its brand, its distribution system, its taste memory. See's Candies has a moat, its reputation, its sentimental value during holidays, its distribution. The textile industry, on the other hand, had no moat whatsoever. It was a commodity business, easily replicated, with no pricing power. My capital was trapped in a business that consumed money faster than it could generate it. This realization didn't come overnight. It was a slow, painful process over years. I kept trying to fix the textile operation, thinking I could make it work, pouring good money after bad. It took until 1985, 2 full decades after I took control, to finally close down the last textile mill operations. That capital, those resources, all that management attention could have been deployed into truly wonderful businesses much earlier. That's the real cost, the opportunity cost of being stubborn and failing to admit a mistake quickly. When we finally did start deploying capital into truly wonderful businesses, the results were night and day. Take our investment in See's Candies in 1972. Charlie and I were sitting in the office one day talking about businesses that just seemed to print money. See's was a simple candy company based out of California, making chocolates. The owners wanted $30 million for it. I thought it was too much. I remember telling Charlie, it's a great business, but $30 million, that's rich. Charlie, in his usual direct way, told me, Warren, what do you think it would be worth if it doubled its sales and still had no capital invested? He pushed me to think about pricing power and brand, not just tangible assets. We paid $25 million for See's Candies. That was roughly 3 times its tangible assets, a price that would have horrified Ben Graham, who always looked for assets trading below book value. But See's had something better than tangible assets, an intangible asset, a brand, and pricing power. It needed very little capital to grow, and it generated tons of cash. Since we bought it, See's has generated over $2 billion in pre-tax earnings for Berkshire. We've never had to put a penny of additional capital into it. That's a wonderful business. Another example that taught me about pricing power and consumer loyalty was American Express. Back in 1964, the company got caught up in the salad oil scandal. A guy named Tino De Angelis had defaulted on huge loans collateralized by non-existent salad oil, and American Express's warehouse receipts were involved. People panicked. Its stock plummeted. American Express travelers' checks were questioned. Its reputation in tatters.
I flew to New York and spent days at their offices talking to employees, even counting the number of people still buying travelers' checks at Grand Central Station. I ate at restaurants, paid with their charge card, and spoke to merchants. What I found was that people still trusted American Express. They still used its services. The brand, the moat was intact. Everyone else was fearful selling their shares, but I saw that the fundamental business was sound. We invested $20 million, a huge portion of my partnership's capital at the time, roughly 40% of its net worth. The stock was trading at a price-to-earnings ratio of maybe 8 or 9. It was one of those fat pitch opportunities, a temporary problem for a permanently good business. That investment paid off handsomely. We bought when others were fearful.
Then there's Coca-Cola. Oh, what a business. Charlie and I started buying Coca-Cola stock in 1988, eventually investing $1.3 billion. At the time, the market didn't fully appreciate the global potential of that brand. People thought of it as just a soda company, maybe a mature one, but we saw a product that was loved worldwide, easily transportable, with incredible brand recognition and a simple, repeatable business model. It had a worldwide competitive advantage. Think about it. You can go to almost any corner of the world and there's Coca-Cola. That simple brown liquid, unchanged for decades, gives people a little moment of happiness. It's a low cost, high volume product with incredible pricing power over the long run. We still own a massive stake in Coca-Cola. That $1.3 billion investment is now worth over $25 billion, and it generates hundreds of millions in dividends for Berkshire every year. That's the power of finding a wonderful business and holding it for the very long term, ideally forever. I made other mistakes, of course. The Dexter Shoes was a truly awful acquisition in 1993, costing Berkshire 1.6% of its stock at the time, which would be worth billions today. I paid for it with Berkshire stock, which was a double mistake, issuing our precious currency for a business that turned out to be worthless. I bought a company without a moat, thinking I understood the shoe business. I was dead wrong. It was a commodity business, just like textiles, and the import flood wiped them out. I wrote in my annual letter that I should have stuck with my circle of competence. I learned that lesson the hard way again. So if you're a young investor today, what I tell my younger self, or any investor for that matter, is this: investing isn't rocket science. It's not about having a super high IQ. I've seen plenty of people with 160 IQs fail spectacularly because they couldn't control their emotions or they tried to make things too complicated. It's really quite simple, but simple doesn't mean easy. It requires discipline, patience, and a healthy dose of common sense. The first step is to learn accounting. You need to understand how businesses work, how money flows in and out, what a balance sheet and an income statement actually tell you. Don't let people tell you it's too complicated. It's the language of business. You wouldn't try to read a book without knowing the alphabet, would you? Well, accounting is the alphabet of business. Ben Graham taught me that, and it served me well for over 70 years. I spend 80% of my day reading annual reports, 10Ks, newspapers, anything I can get my hands on that helps me understand businesses better. The second thing is to think about a stock as a piece of a business, not just a ticker symbol that flashes on a screen. When you buy a share of Coca-Cola, you're buying a tiny piece of that worldwide enterprise, its factories, its brand, its management. Ask yourself, if you were offered the entire business, what would you pay for it? Would you want to own it forever? That's the mindset. You wouldn't buy a hamburger stand without knowing anything about its sales, its costs, its competition. Treat stocks the same way. And then there's Mr. Market. Ben Graham's wonderful analogy. Imagine you have a business partner named Mr. Market. Every day he comes to your door and offers to buy your share of the business or sell you his at a price that he names. And here's the kicker. Mr. Market is a manic depressive. Some days he's euphoric, sees only good news, and offers you a sky-high price. Other days he's depressed, sees only bad news, and offers you a ridiculously low price. Paragraph break. The critical lesson from Mr. Market is that you don't have to listen to him. You can ignore him. You can tell him to come back tomorrow. The market is there to serve you, not to instruct you. When Mr. Market is euphoric, don't get swept up in the craze. When he's depressed and offers you a wonderful business at a bargain price, that's when you should be buying, assuming you've done your homework. Be fearful when others are greedy, and greedy when others are fearful. That's not just a cute saying. It's how you make money in this game. People think you need fancy algorithms, complex math, or daily trading to get rich. That's a myth. It's really quite simple. We look for businesses we understand that have a durable competitive advantage, a moat run by honest and capable management, and then we try to buy them at a fair price, ideally with a margin of safety. Then we hold them. Our favorite holding period is forever. Compound interest, my friends, is the eighth wonder of the world. Let time and good businesses do the heavy lifting for you. This applies to any business, not just investing in publicly traded companies. What really matters in business, whether you're starting a local bakery or running a multinational conglomerate, is the underlying economics of the enterprise. Does it have a product or service that people genuinely need or want, that they'll pay a fair price for? And that's hard for competitors to replicate. Is it run by people you trust, who are good at allocating capital and who care about their customers and employees? Over at Berkshire, we have always looked for managers who love their businesses as if they were their own, who are decentralized and who just keep doing what they do best without me looking over their shoulder. Someone like Tony Nicely, who ran Geico for decades, or Ajit Jain, who runs our enormous insurance operations. These are people who understand their businesses inside and out and execute beautifully. We buy good businesses with good managers, and then we get out of their way. It also comes back to the human nature. Markets are driven by fear and greed, by hope and envy. It's human nature to want to follow the crowd, to chase the latest hot stock, to panic when things get rough. But that's exactly what you need to resist. You need to develop an inner scorecard, judging yourself by your own principles, not by what everyone else is doing or saying. My dad taught me the importance of that inner scorecard early on, and it's probably the most valuable lesson he ever gave me. Paragraph break, but that's not the only lesson I learned the hard way. The danger of getting too comfortable, of falling in love with a stock. That's another trap many investors fall into, including me sometimes. It reminds me of another time when I was too slow to act, and it cost us dearly an opportunity. I mean, there's always something new to learn, even at my age. We bought US Air preferred stock in 1989. It was a high yield preferred, and it looked good on paper at the time. The airline industry, though, is notoriously difficult. It's a capital-intensive business, unionized, susceptible to economic cycles, fuel prices, and fierce competition. It's a terrible business with virtually no moat. We made a decent return on the preferred stock, but I wrote in my annual letter that year that the experience left me with no desire to buy the common stock of an airline. It was a business that simply chewed up capital. Yet many years later, what did I do? I made another foray into airlines, buying stakes in American Airlines, Delta, Southwest, and United. What a bonehead move that was. I talked about it in one of our annual meetings, with 40,000 shareholders filling the CHI Health Center arena back home in Omaha. I said I was making another mistake, and Charlie just sat there nodding. Then COVID-19 hit and the airlines got clobbered. We sold all our airline stocks at a substantial loss. It's a mistake of omission for many years, not buying some wonderful businesses, and then a mistake of commission, going back into a difficult industry I knew I didn't understand as well as I thought I did. It showed that my circle of competence was still being tested even after all these decades. The truth is, sometimes you just plain forget the lessons you've learned. My circle of competence, I talk about it a lot. It's not about how big your circle is, but how well you define its boundaries. I don't invest in things I don't understand. For a long time, that meant tech companies. I remember sitting there in the office looking at these internet companies in the late 90s and thinking, I don't get it. Everyone else was piling in and they were making money hand over fist. I felt dumb, like I was missing out, but I stuck to my gun. I told myself, if you don't understand it, don't invest in it. And that saved us from the dot-com bust, which wiped out a lot of smart people. But then fast forward, we bought into Apple, a huge position, now one of our biggest. A lot of people scratch their heads. Buffett buying tech. Well, the thing about Apple is I don't think of it as a tech company in the traditional sense. I think of it as a consumer products company. When I see people lined up for the new iPhone, when I see how ingrained that device is in people's lives, how sticky the ecosystem is, how much people are willing to pay for the next upgrade, that's a powerful brand. That's a powerful moat. People aren't just buying a gadget, they're buying into a lifestyle, a feeling, a brand that resonates deeply. That's something I understand. It's like Coca-Cola in your pocket. So sometimes the categories change, but the underlying principles of a durable competitive advantage and customer loyalty remain the same. Another lesson tied into that is to avoid debt. I've never borrowed significant money to invest. People get into trouble when they borrow to buy stocks or when companies load up on debt that they can't service if times get tough. Leverage can magnify returns, sure, but it can also magnify losses to the point of ruin. Charlie and I prefer to sleep well at night. We always have a huge cash pile at Berkshire for a reason. It gives us flexibility, allows us to act when others can't, and protects us from the unexpected. I remember when I was a kid back in Omaha during the Depression, my dad ran a stock brokerage, And I saw firsthand how quickly things could fall apart. People lost everything. I delivered newspapers and saved every penny. I bought my first stock, City Service Preferred, at age 11 for $38 a share. It went down to $27 and I was terrified. It finally went up to $40 and I sold it for a small profit. Then it soared. I learned about patience and about not being too quick to sell, but also about the agony of seeing your investments drop. That early experience with the market and seeing the fragility of fortunes really stuck with me. So for the next generation, please don't try to time the market. You can't. Nobody can. Don't pay attention to what the talking heads on TV are saying or what your neighbor is bragging about. Just buy a cross section of American business like a low cost index fund and hold it for decades. Let compounding do its magic. It's not glamorous, it's not exciting, but it works. It's simple, it's boring, and it will make you rich if you're patient. And don't get caught up in the speculation. The dumbest reason to buy a stock is because it's going up. That's just gambling. Price is what you pay, value is what you get. Focus on value. Focus on what the business is actually worth, the future cash it can generate. If you don't understand that, then you shouldn't be buying individual stocks. Stick to the index fund. There's no shame in that. In fact, for most people, it's the smartest move. After 94 years of doing this, here's what I know for certain. The foundations of good investing and good business are timeless. They don't change with technology or economic cycles. It's about fundamental principles, understanding what you own, buying businesses with competitive advantages, finding good people to run them, and having the temperament to act rationally when others are acting irrationally. I'm 94 now, and if I could tell young investors one thing, it would be this: invest in yourself first. Education, continuous learning, and building good habits. Those are the best investments you'll ever make. Choose your friends and your spouse carefully. They'll have an enormous impact on your life. And always prioritize honesty and integrity. It's the easiest way to go through life. I never bet against America. The ingenuity, the drive, the resilience of the American spirit is incredible. We've faced challenges before, and we've always come out stronger. The free market system, for all its imperfections, is the greatest engine of prosperity the world has ever known. So have faith in that. Be optimistic, but be patient. You don't need to be brilliant. You don't need inside information. You don't need complex formulas. You need a sound intellectual framework, a strong emotional discipline, and a willingness to learn from your mistakes and from others. My office here in Omaha, it hasn't changed much over the decades. I still drive myself to work every day, still read hundreds of pages, still play bridge with friends like Bill Gates and Charlie. It's a simple life focused on what matters. My partner Charlie always tells me, all I want to know is where I'm going to die, so I'll never go there. It's his way of saying, avoid stupidity, avoid bad decisions, avoid the things that will cause you to lose money or miss opportunities. If you avoid the big mistakes and you have patience and discipline, the power of compounding will work its magic for you. It really is that simple. Good luck to all of you. And remember, the best investment you can make is in yourself.